Hello everybody, Nation So Jackson CPA here with another video for you for Financial Literacy Month. As you know, April is Financial Literacy Month, and we've been doing a series of videos talking about some topics that we want you to think about and consider as you embark upon your journey towards financial freedom. Today's topic is going to be debt. Debt, and whether it's good, bad, not so in between, we'll see. We'll figure that out. We're going to talk through some things to give you some thoughts and some food for thought. Stick around, stay tuned, subscribe, all that great stuff. Be back in a second. Everybody, welcome back for today's episode on YouTube. Alright, so today we're going to talk about debt. Alright, why are some people so afraid of debt? I don't know. So I'm going to give you my thoughts. Alright, I don't enlist to the Dave Ramsey philosophy that all debt is evil. That's not what I believe to be true. Now, there is some debt that is bad and some debt that you should try to avoid at all costs. That's very accurate. Obviously, we want to make sure that we're not spending a ton of money on interest in relation to credit cards and some other debt items that are out there that charge exorbitant amounts of interest, okay? Because that can absolutely eat into your ability to get to that financial freedom, to build that generational wealth, to bridge the wealth gap that we have in the country, okay? That ultimately is the objective and the goal of investing wisely, is to bridge that gap, all right? Now, in my opinion, I believe that, it is perfectly okay to use debt appropriately, all right? All debt is not bad. All debt is not evil. There is such a thing as good debt, okay? One of the best types of debt that you can have out there would be mortgages. All right, so I did a video recently on mortgages and the mortgage interest rates and how not to get too much of a house, how to be reasonable with what you're doing. But if you get and you use the money wisely, getting debt on a mortgage is not bad, okay? Now, over leveraging your mortgage could become bad because it gets you into a situation where you might have negative equity if the market ever takes a downturn, and you get into a situation where you just have to sell. You kind of get to a bad spot where you need to sell. You don't want to be in that position where you have negative equity. So, keeping at least 10 to 20% of equity in each property should be the objective and the goal. But leveraging the rest of it, to me, is not that big of a risk or that big of a concern. 2 to 3% interest, which is kind of where the rates are right now, somewhere in that 2.5 to 3.5, 4% range is about where the interest rates are on mortgages right now, and that's really low. I mean, if you think about it, the average returns in the S&P 500 is about 7% to 10%, so somewhere in that range. S&P 500, any other index that's out there, really, those are the average returns right now that we're seeing in the marketplace. A little bit higher than that over the last year just because of everything that happened with the coronavirus pandemic, where they had a huge downturn. So if you got invested, during the downturn last year, you're seeing greater returns than you normally would. But overall, over the lifespan of, let's say, 20 or 30 years, you're going to experience an average of about 7 to 10% if you just invest in the stock market. You do nothing else but invest in the stock market. So the question you got to ask yourself is, if I had an extra $10,000 to pay down my mortgage or to invest in the stock market, what would you rather do? To me, the opportunity cost is too great to pay down your mortgage, okay? Now, if I didn't have 10 or 20% equity in my mortgage, then in that case, maybe I might consider going ahead and, paying down some of the mortgage to get me to that level. But outside of that, the rest of it's going towards investments, all right? Buying rental properties, investing in the stock market, and giving out loans to small business owners. I don't know, there's tons of other things that you can do to invest your money. Crowdfunding campaigns, all sorts of things that have the potential to get you a much higher return on your dollars, okay? So to me, it's some of the cheapest debt that you can use to borrow is against a piece of real estate, okay? And I will tell you that if you look at a lot of the rich people out there, a lot of the wealthy people out there, they all use debt effectively, okay? Businesses, large corporations, pretty much all have some sort of debt. Even if they have tons of cash flow coming in, they have some sort of debt because it allows them to, again, it's opportunity costs. They get it at a low rate, 3%, 4%, whatever it is, and they utilize that to go and make more money, okay? If you're using the debt to go make more money, it's good, all right? And you get returns that are greater than what you're paying interest. That's a wise investment, okay? This is a wise use of your cost of capital. Whereas if you use debt, and we're gonna get into the credit cards now. If you use your credit card to go buy that pair of shoes, that $1,000 purse or bag, handbag, whatever it is, you go buy some other crap that you don't necessarily need, some more stuff that you want, and you're using a credit card to go do that, and you don't have the money in your bank to go and pay that off at the end of the month when you get your statement, that's not smart. That's bad debt. That's what you need to avoid. All right. That's the knockout punch, as you can see from my shirt here. Yeah, you do not want to do a bunch of credit card debt. That is the worst thing that you can do when you're not paying that off every month. Now, if you have the money in the bank and it's something that you decide that you want to go spend money on for that particular month, you want to treat yourself to something nice, and you can pay that credit card off once you go and use it, totally fine. Okay. And on the other point in regards to credit cards, okay, there's nothing wrong with using credit cards. Again, the issue with using credit cards is if you use them unwisely, all right? If you don't use them effectively, all right? You should always be making money off of the credit card company by earning rewards on your spend versus paying them interest, okay? The reason why they offer those rewards is because there's a lot of people who don't use their credit cards effectively, and they end up spending more in interest than what they're making on the rewards that they're earning on the credit card, okay? That's a bad scenario, all right? You should always be striving to pay that credit card off every single month. Now, could there be months here and there that you can't quite get to that level? Yes, and that's fine. You know, if you have a month or two where cash flow is a little tight, especially if you're a small business owner, that can occur. Okay, that's not the end of the world. But you don't want it to stay that way for very long. You want to get back to the point where you have it paid off every month and you're only using basically what you can afford to pay off each month, okay? So, but if you use credit cards wisely, they are a phenomenal strategy to make tons of money. Let's say you spend $100,000 a year in your business, okay? And there's credit cards, business credit cards out there that give you 2% annual cash back or annual return, okay? Rewards credits or whatever you want to call them, okay? That's a lot of money that you just saved yourself, okay? That's on $100,000, that would basically be $2,000, all right, that you get back and that you saved yourself by using that credit card effectively. Now, the key would be you should be paying it off each month. You know, hopefully your business is not operating at a loss to where you have the revenue coming in to be able to pay off that credit card every month to where you're not having a negative effect on your bottom line. Okay, so that's the key. You know, all debt is not evil. All debt is not bad. That's the main thing I want to kind of get across to you is think about what you could be doing with that money, the opportunity cost that you're passing up by paying off the mortgage. Now, I know the good old adage, oh, well, you don't really own the home until you don't owe the bank, blah, 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 blah. Who cares about that? I'm just telling you, you could have made over, let's say, 10 years. Let's say you were able to pay off $50,000 on a mortgage, and you have $200,000 left on your mortgage, and you have $50,000 that you could put towards something. Okay, you could have paid off the mortgage, fine. You probably saved yourself, I don't know, a few $1,000s in interest, okay? Or you could have invested it, getting a return of 10 to 20% on some sort of investment, which is very real and very possible over the next 10 years, okay? And that's a 10 to 20% annual return. That $50,000 could easily turn into a couple $100,000 when it's all said and done over 10 years, okay? So, which you got to see the point to this, all right? if you want to retire early, if you want to get to that retirement stage, you have to use debt to your advantage, is what it comes down to. You got to use debt to your advantage. When you use other people's money to make you more money, that basically equates to you being smart, is how I would describe it, okay? That is going to get you to a point where you're not going to have this knockout, all right? You're going to have plenty of cash flow in the bank. I'd rather have enough cash sitting in the bank or in investments and things of that nature that will allow me, if I needed to go ahead and pay off my mortgage if I really needed to, okay? Or to pay a big amount to get out of a particular situation. I'd rather have that than to have it tied up into the bank, okay? And if you ever need it, by the way, in a downturn, okay, let's say you paid off your mortgage, all right? And let's say you don't owe any debt on your house. And let's say you get into a situation where you lose out and you have no money, or et cetera, et cetera, et cetera. You don't have a job, you don't have any of that. Here's the key. Tell me what bank is going to give you a loan against your mortgage when you have no money and no job. I'm waiting. Just tell me. Anybody, tell me. Leave a comment. I want you to leave a comment in this video. If you could tell me a bank that will give you a loan when you have no job and no money. Tell me. Just tell me. I don't care what the value of that asset is. It's not freaking happening. Okay? So you don't get so tied up on paying down your house. All right? Use that money effectively. Invest it wisely. You're going to get more money over the long term, which will ultimately mean you are going to be rich and wealthy well beyond years, okay? You're going to pass this along to your kids, etc., etc. Invest it. Don't spend it on your house. Don't spend it on your mortgage, your rental properties. Go buy more rental properties. Instead of paying off that mortgage on that rental property, go buy more rental properties, okay? Again, just don't over-leverage them. Where people went wrong during the 2008 crisis and other scenarios where people were losing homes is they over-leveraged them. As long as you don't over-leverage it, it's good debt. All right. There's other good debt out there besides just mortgages, by the way. If you get, let's say you wanted to go buy a new car, I don't really consider that to be good debt per se, but it's not horrible debt. I mean, most of the interest rates on cars, you can get 2 to 3% if you have good credit. Okay. And you paid attention to my credit video and you have good credit, then, that's not horrible. I mean, you need a car. But the key is, don't get too much car that's to where, you have a huge, massive payment and it's affecting your ability to invest in yourself. That's the key. Don't overextend your car to where it's such a large amount, such a large payment that you can't really invest in yourself. But again, that's a situation where would I rather pay cash for a car or have a 2% loan or a 3% loan on the car? I'd rather just have the loan on the car, to be perfectly frank. Maybe make a down payment of let's say it's $30,000 car, make a down payment of $5,000, $8,000, something like that, to where hopefully you don't ever get to a situation where you have negative equity, to where if you ever needed to, you could sell the car and get from under it, right? Get to that point. But after that, definitely use the debt. There's nothing wrong with using some debt because it's fairly cheap debt, okay? Other debts, there's certain loans and things like that you can get out there for businesses and things of that nature that are lower interest, 5% interest rate or below. To me, if the interest rate's 5% or below, that's pretty decent debt, okay? That's a good use of borrowed funds, borrowed capital. If you invest it wisely, you should be going out there and making yourself more money. Now, if you have debt and you're not doing anything with the extra cash flow that you get, then yes, that doesn't make sense. All right, you got to change up your financial picture to where you're using debt to your advantage. All right, anywho. All right, enough about that. I think you guys get the point. All debt's not bad debt. There is such a thing as good debt. I don't believe in the Dave Ramsey philosophy of paying down your mortgage and paying down all debt and having no debt and being debt free and paying for cash for everything. I don't believe in that crap. So, but it's up to you. I mean, everybody has their own individual choice. Everybody, it's the constant battle between, investing smart versus emotional attachment to not wanting to have any debt. There's some people who really just don't want to have any debt emotionally, and they cannot get over it. No matter how much the numbers make sense, how much the numbers will prove that they're going to be richer quicker. They'll make more money quicker if they use the debt to their advantage. There's some people out there that just can't get over the emotional attachment of having debt attached to their house, or whatever the case is. So anyways, food for thought, something to think about during this financial literacy month. Hopefully you enjoyed the video. Again, we are giving away some prizes, so definitely like, subscribe, so that we know who you are, that you're out there. Leave a comment in the video, so do something to where we kind of understand that you want it to be entered for the drawing, and so that way we can also kind of help to grow the channel and get more eyes on this. Okay, so hope everybody has a great day, and if you have any questions or anything like that, feel free to leave a comment, and we'll see what we can do to respond. Okay, hope everybody has a good day. We'll talk to you later. Bye.